Here's something most people never think about until it's too late. Two retirees, same Social Security benefit, same amount of money saved, same Medicare plan, but one of them pays thousands of dollars more every single year in taxes and Medicare premiums, simply because of their filing status. That's not a mistake. That's the tax code working exactly as designed. And if you don't plan around it, it will cost you. I'm Shonda Prescott, and welcome to Retirement Security Simplified, where we break down the complex stuff so you can make smarter decisions with your money. Today, we're talking about one of the most overlooked differences in retirement planning: how being single versus being married changes everything about how your income is taxed, how much you will pay for Medicare, and how you need to structure your retirement income to protect what you've worked so hard to build. Whether you're single, married, recently widowed, or planning ahead, stay with me because this one could save you a lot of money. Most people know that married and single filers have different tax brackets. But what most people don't realize is just how dramatically that difference plays out once you're retired and living on a fixed income. Here's why it matters so much in retirement specifically. In retirement, your income typically comes from a combination of Social Security, retirement account withdrawals, maybe a pension, and investment income. The IRS and Medicare both look at that income, but they apply very different rules depending on whether you file as single or married filing jointly. And here's the problem: single filers face tighter income limits, steeper thresholds, and less room to maneuver. You hit the penalty zones faster with less income. And if you're a surviving spouse who just lost a partner, you may be blindsided by a sudden jump in your tax bill and your Medicare premiums on the exact same income you had before. This is not a small issue. For many retirees, we're talking about thousands of dollars a year. So let's walk through exactly where these differences show up. Let's start with Social Security taxation, because this is where single retirees often get hit hardest and don't see it coming. Here's how this works. The IRS uses a formula called combined income, sometimes called provisional income, to determine how much of your Social Security benefit gets taxed. That formula is just your adjusted gross income, or AGI, plus any tax-exempt interest, plus 50% of your Social Security benefit. Now, here are the thresholds. If you're single, once your combined income hits $25,000, up to 50% of your Social Security becomes taxable. And once it hits $34,000, up to 85% of your benefit is taxable. If you're married filing jointly, those thresholds are $32,000 for the 50% tier and $44,000 for the 85% tier. At first glance, that might not seem like a huge difference, but let me show you why it is. Let's say you're a single retiree receiving $20,000 annually Social Security benefit, and you take a $30,000 withdrawal from your IRA to cover your living expenses. Your combined income is $30,000, which puts you right in the 85% taxation tier. That means up to $17,000 of your Social Security benefit could be subject to income tax. Now, take a married couple with the same Social Security benefit and the same IRA withdrawal. Their combined income is the same $30,000, but because their threshold is higher, they're still in the 50% tier. The tax hit is significantly smaller. Same income, very different tax bill. And this is exactly why single retirees need a more precise income plan. You have less cushion. Every dollar of income you pull from the wrong source at the wrong time can trigger a bigger tax bill on your Social Security. Now, let's talk about IRMAA, the Income Related Monthly Adjustment Amount. This is the Medicare surcharge that gets added to your Part B and Part D premiums when your income exceeds certain limits. And just like Social Security taxation, it hits single filers much harder. Here's how IRMAA works. Medicare looks at your modified adjusted gross income from 2 years ago to determine your current surcharges. So what you earned in 2024 affects what you pay for Medicare in 2026. That's called the look back rule, and it catches a lot of people off guard. Now, here's where the single versus married gap really stands out. A single filer with a modified adjusted gross income above $106,000 will trigger the first IRMAA surcharge tier. A married couple doesn't hit that same tier until their combined income reaches $212,000. That means a single retiree with $110,000 in income gets hit with an IRMAA surcharge. A married couple earning the exact same $110,000 pays standard Medicare premiums, not a penny more. And this problem gets even more painful for surviving spouses. Imagine a couple that planned their income together, stayed comfortably below the IRMAA thresholds as a married couple, and then one spouse passes away. The surviving spouse doesn't get to keep the married filing jointly thresholds. They drop to single filing status. Suddenly, the same income that was perfectly fine before now triggers IRMAA surcharges and higher Social Security taxation. That's called the widow's penalty, and we'll come back to it in just a moment. The planning takeaway here is this. If you're single or if you're a married couple planning ahead, you need to be actively managing your modified adjusted gross income. Tools like Roth conversions, qualified charitable distributions from your IRA, and structuring your annuity income strategically can all help you stay below these thresholds and avoid unnecessary surcharges. Now, let's get practical. How should single and married retirees approach their income planning differently? Let's start with single retirees. If you're single, your income plan needs to be precise and resilient. You don't have a second income to fall back on. You don't have a spouse's Social Security check coming in if yours falls short. And you don't have someone to help absorb expenses if a big cost comes up unexpectedly. That means guaranteed lifetime income is not a luxury for single retirees, it's essential. A fixed indexed annuity with an income rider can function as your personal pension, providing a paycheck you cannot outlive no matter how long you live or what the market does. That income floor gives you security and predictability that no market-based strategy can guarantee. For single retirees, the goal is also to keep your provisional income as low as possible to protect your Social Security from heavy taxation. That might mean drawing from Roth accounts first, delaying IRA withdrawals, or using a qualified charitable distribution if you're already taking required minimum distributions. If you're in your early 60s and not yet taking Social Security, this can also be a great time to consider a Roth conversion strategy. Moving money from your traditional IRA into a Roth over several years to reduce your future taxable income and your future RMD burden. Now, let's talk about married couples. Married couples have more planning options, but also more complexity. Here are the strategies that matter most. First, coordinate your Social Security claiming carefully. In most cases, the higher earning spouse should delay claiming as long as possible, ideally to age 70, to lock in the maximum benefit. Why? Because when one spouse passes, the surviving spouse keeps the higher of two benefits. Maximizing that benefit today protects the survivor tomorrow. Second, think about income layering. Because you have two people with potentially two different income sources, you can be strategic about which accounts you draw from and in what amounts to stay in lower tax brackets and below IRMAA thresholds. Third, if you're using a fixed indexed annuity, consider whether a joint life income rider makes sense for your situation. This type of rider ensures that the guaranteed income continues at the same level or a set percentage for the surviving spouse, so no one is left scrambling to replace lost income. And fourth, plan proactively for the widow's penalty. This is critical. At some point in almost every marriage, one spouse will survive the other. When that happens, the survivor's tax situation changes dramatically. They shift from married filing jointly to singles filing status. Their Social Security taxation thresholds drop, their IRMAA thresholds drop, and their standard deduction shrinks. The best time to plan for that is now, not after it happens. A well-structured retirement income plan accounts for that transition and makes sure the survivor is protected. Whether you're single or married, one of the most powerful tools for creating a secure retirement income is a fixed indexed annuity with an income rider. Here's why this matters regardless of your filing status. A fixed indexed annuity gives your money the opportunity to grow based on a market index, like the S&P 500, without ever being directly invested in the market. That means your principal is protected from market losses. You can never lose money due to a market downturn. The income rider adds a guaranteed lifetime withdrawal benefit. Think of it as a personal pension you create for yourself. Once you turn the income on, it pays you a set amount every single year for the rest of your life, no matter how long you live, and no matter what happens in the market. For single retirees, this is your safety net. It removes the fear of outliving your money, and it gives you a reliable income floor to build the rest of your plan around. For married couples, a joint life income rider means the income continues for both of you and keeps paying for the surviving spouse after one of you is gone. That's a powerful protection against the widow's penalty we talked about earlier. And from a tax and IRMAA planning standpoint, because you have control over when and how much income you take from an annuity, it becomes a flexible tool for managing your provisional income and your modified adjusted gross income from year to year. So let's bring it all together. Whether you're single or married, your filing status has a direct and significant impact on how much of your Social Security gets taxed, how much you pay for Medicare, and how much of your retirement income you actually get to keep. Single retirees face tighter thresholds and need a more precise guaranteed income plan with less margin for error. Married couples have more planning flexibility, but they also need to plan ahead for the surviving spouse because the widow's penalty can be a financial shock that nobody saw coming. The good news is that with the right strategy, the right income structure, the right account withdrawals, and the right guaranteed income tools, you can minimize those taxes, avoid IRMAA surcharges, and build a retirement income plan that works for your specific situation. If you'd like to learn more, take a look at the free booklet called Retire Smart. It's linked on the page in the description box. If you found this video helpful, please give it a thumbs up. Leave a comment below and let me know whether you're planning as single or as a couple. I'd love to hear from you. And make sure you subscribe so you don't miss the next video. This is Retirement Security Simplified, where we specialize in turning confusion into confidence, one conversation at a time.